April CPI print showing that inflation eased last month, but prices are still holding at elevated levels. Shelter and gas were two areas where prices remain sticky. Join us as we unpack the details of April's CPI print.
Yesterday's consumer price index showed that the cost of shelter, which includes rent, grew by 0.4%, putting it up over 5% from this time last year. So it's now a good time to invest in real estate. For more, let's bring in Lauren Hochfelder, who is the Morgan Stanley Real Estate Investing co-CEO. Great to have you here with us, Lauren. First and foremost, a lot of people just trying to figure out how much they should be allocating, if they are allocating a real estate investment here. What's a good way to get an entry point in?
So, hi, Brad. Thanks for having me on, and always love to talk to you about real estate. So, look, we think this is a really, really interesting time to be investing in real estate. We're 2 years into a real estate correction, and you're seeing broad repricing across the board. There are certainly some assets that are distressed for a reason. We tend to stay away from those. But across the board, there are a lot of asset classes that are really interesting, performing quite well in terms of income growth, et cetera. And yet they're pricing off materially 20, 30%. So we think it's a really interesting time to get in.
Let's kind of drill down on it, because real estate, very broad. Are we talking single family, multifamily, rental units? What is it that is seeing the most kind of demand, or the most opportunity, at least, as an investment mechanism?
Yeah, so we like to invest behind broad mega trends that drive demand through cycles. And so some of the mega trends we're focused on today are continued growth in e-commerce. I heard your conversation about Walmart e-commerce sales, and that absolutely, as a trend, continues, and that drives a lot of demand for those warehouses that get those goods to our front doors every day. So that's one. The second is a complete realignment in the global supply chain. So simply put, the supply chain of the last 20 years will not be the supply chain of the next 20. We're doing a U-turn on globalization, all these event-driven supply shocks. And again, as companies are forced to rebuild their infrastructure in response to a realigning supply chain, that too drives demand for warehouses. The third is, look, we have aging demographics. As a population, we are aging, and that is changing our housing preferences and needs. So there is a lot going on. And in real estate, you have to distinguish between changes in interest rates and changes in how people use space.
I want to linger on that for a hot second here, and the changes in interest rates. How is that weighing into the decision as people weigh real estate as an investment mechanism and asset type?
Well, look, real estate is a levered asset class, and of course it is heavily impacted by interest rates. I'd say that we like to invest in a way that we can perform through any interest rate cycle. Today you're seeing a lot of asset owners who acquired assets and financed them heavily in a very different interest rate environment, and they are getting squeezed today. They have maturities coming up, and they cannot refinance that debt at the current levels, and that's creating pressure in the system. We focus on having durable capital stacks that enable you to get through any interest rate environment. And frankly, we focus on investing in real estate where you can really push income growth, where you can grow your top line in excess of any rate expansion.
When we think about real estate investing, it comes back to one word repeated 3 times continuously: location, location, location. And for any of the types of real estate investments, whether it is looking at warehouses, whether it's looking at even the build out of data centers or even multifamily homes, all of these things considered, it still comes down to where those are placed. Is there a hot spot where you're seeing investors kind of flock towards in their calculus of the locations that are best serving for this as an investment strategy?
Absolutely. Look, first, I'd say on a global basis, I do think the U.S. is really the most interesting place to invest today. But let me say, you're absolutely right. It was ingrained in my brain, location, location, location. But I'd say today it's actually Of course, location is paramount, but I would say it's dislocation. You have to look at how things are changing, whether that's where people are moving. So, I would have said 20 years ago, you want to own assets in New York City, and certainly, there are some you still want to own here, but people have migrated, right? People test drove a lot of different things in COVID. They test drove different working conditions. They decided they liked working from home. They test drove different markets, right? So Miami, Dallas, some of these markets to which people moved really changed the location of where you want to own real estate.
Well, stocks hitting record highs this week after the inflation data print out yesterday morning came in line with expectations, reigniting some of that optimism that we have seen on the street that we could see a rate cut before the end of the year. And taking a look at where things stand today, you've got the S&P holding on to positive territory, pushing further above that 5,300 level. You've got the the Dow, just below 40,000. We, of course, are going to monitor that and see whether or not we can reach that level. Here to tell us more on where the markets are headed, we want to bring in Kevin Gordon. He's Charles Schwab Director and Senior Investment Strategist, here to break it all down. So, Kevin, I'm curious, how are you looking at the levels that we're currently trading at, and whether or not you do still see some room here to the upside?
I think there's room to the upside, but I think more important to keep in mind is what's going to get us there, number one, and then number two, kind of what to expect, and maybe paring back the expectation of really strong gains, akin to what we've seen if you go back to last October, when we really got this leg higher after that correction. And I say that because, so much focus this earnings season has been on companies, for the most part, at least for the S&P 500, different story down the cap spectrum, doing relatively well. But in our mind, when you look at the data and you look at the outperformance for companies relative to the S&P or whatever benchmark, even when they're beating earnings, there hasn't been outperformance. You've actually seen an average decline of 0.2%. So when you factor in sales and there's a beat on sales and earnings, that's when you've gotten strength. But when you start to look at where we are now in the earnings cycle, now you're moving back into double-digit territory in terms of earnings growth. That's actually a weaker zone. You're still seeing gains, but historically a weaker zone for the stock market. The strongest zone is when you're between down 20% and up 5% for earnings. So we've already exited that zone. Now we're just moving into something that's a little bit more, consistent with maybe relatively, less strong gains, I would say. But you're not in negative territory. So that's the one thing. The second thing being what you mentioned about rate cuts. I'm not sure that we should put so much emphasis or so much focus on the Fed cutting being necessarily a bullish or a bearish thing for the market. It really matters more as to why they're cutting, what the economic environment looks like, because if they're cutting for the wrong reason with unemployment surging and the labor market deteriorating, that wouldn't be a risk-on scenario for the market.
And so you mentioned that even if companies are beating, they're still not being rewarded as much as we've seen in the past. So that would almost kind of spell out this hyper Goldilocks scenario that we could be navigating through for the rest of this year, even leading up to the election in November as well here.
Yeah.
How would you evaluate that? And what have we typically seen in those types of environments?
Well, I think it speaks to what the focus has been on the part of the market, where if you're beating on earnings and if you're achieving really strong earnings growth and in a profit scenario just based on aggressive cost cutting, that's just not good enough anymore for the market. So you're at the point in the cycle now where you need to start seeing actual sales growth and revenue growth improve, because we've been in an environment of decelerating revenue growth, still positive, but the change has been sort of moving lower. So as long as you start to see that improve in the back half of this year, which we would expect to be the case, then you can get another leg higher in the market. But you need to see both of those come into play in addition to strong guidance. That's another key area where we haven't seen as much strength on the part of the market's reaction as if a company's revising guidance to the downside. That's been to the detriment of the stock price.
Kevin, what about the fact that we've seen some of these defensive sectors coming into favor? When you take a look at the fact that consumer staples, utilities, both trading above their 52-week highs, is that a bullish sign for the market, or is this something that maybe investors would be looking at a bit bearish?
Yeah, I think the natural, maybe human reaction is to look at something like utilities and staples, the strength you've seen there, especially leading this next leg higher, mostly for utilities, not as much for staples. But the breadth has still been strong for both. But the natural reaction would be to say that that's a bearish indicator. It's hard when you look back in history and look at these prior episodes of markets reaching new highs or doing well with the defensives also doing well and say that that's a bad thing. You have one instance being the lead up to the global financial crisis, but that's a sample size of one. And I also think that when you look at something, especially like utilities, a sector that got deeply oversold back in October, we have to keep in mind that relative to the S&P, for the utilities low in October of 2023. Relative to the S&P, you hit an all-time low, and then in absolute terms, the sector fell to a 3-year low. Very unusual to see in the first year of a bull market. So I think that part of the strength that you've seen can be attributed to the fact that that sector just got deeply oversold, and people are now buying into the momentum.
And so with that, how much momentum is there left? I mean, I'm sitting, looking over your shoulder, 39,918 for the Dow right now. All of us are just waiting to whip out the 40K hats at this point. But how much more room to run from there are you anticipating?
Well, it depends. I mean, if you're talking about momentum as a factor, we went through a pretty swift contraction because when you look at that late March to mid-April period, the mini pullback, if you want to call it that, not a full-blown correction for the S&P. But what was leading that were some of the momentum names that had been in that spot and dominating the momentum factor since late October, early November. So if they get put back in and then you continue to see momentum outperform, it's understandable as to why that could lead you higher. Especially if now what would be interesting is, given the run you've seen in utilities, if some of those names and some of those industries now start to move into momentum, because momentum as a factor is not just tech or communication services. It's just whatever's been doing well. So you can easily swap in another sector and see momentum as a factor continue to do well.
Kevin Gordon, Charles Schwab, Director and Senior Investment Strategist. Thanks so much for taking the time here.
Good to see you.
Good to see you too.
Thanks.
S&P 500, NASDAQ in record territory. It's after a soft reading on inflation. The consumer price index rising 0.3% in April over the previous month and 3.4% from a year ago. We also saw retail sales coming in flat as the consumer showing signs of slowing last month. Joining us now to break it all down, we've got José Torres, Interactive Brokers Senior Economist, as well as Edward Jones, Senior Investment Strategist, Angelo Kourkafas. José, let's start with you here. And we'll start, José, with that CPI print. What did you make of it, José? And importantly, what do you think Jay Powell made of it?
Thanks for having me, Josh. Well, I think that it was a cool reading and the market's loving it. I think the Fed is liking it too, but an important consideration is that most components actually inflected higher. We really got bailed out by new and used automobiles within this print. Now, the good news is that commodity prices are down big this month, and we're probably going to get the first favorable inflation report for the year next month. However, from January through April so far, every single inflation print has been quite above the Fed's annualized 2% target. And the standard there is roughly 17 bips month over month. I'm concerned that services disinflation hasn't occurred all of last year or this year. I think goods and commodities are starting to work their way lower, but services remain the problem.
So if services remain the problem, then, Angelo, and as I mentioned, we are seeing the market start to still price in maybe some interest rate cuts by the end of the year. Obviously that number has been swinging quite a lot as we've gotten each new economic data point. But do you think it's likely, given this latest information?
Yes, we think 1 to 2 rate cuts are realistic. I think today was the combo of Fed-friendly data, looking at both the CPI and retail sales, that validate the Fed's stance of not considering further rate hikes from here, but signaling patience. Although the market, the number didn't deviate very much from expectations, I think markets are breathing a sigh of relief that disinflation continues. The trend remains lower, even though we are walking down a bumpy path, if you will.
José, let me bring you back here because Angelo did mention retail sales. I want your take on that as well. April retail sales unchanged, weaker than consensus. The team at Pantheon Economics, José, saying this was, in their words, a clear signal of weakening consumption. Is that how you saw it, José?
Well, Josh, since 2022, we've seen consumer spending in some months really fall off a cliff, only to recover quite strongly. Consumer erraticness has been part of this cycle for the last 2.5 years, roughly. So I'm not ready to call the consumer quits just yet. They might come back quite strongly the next month. However, savings are really depleted. Sentiment is down. Consumers are not only concerned over higher prices and lofty interest rates, they're also now fearing their job stability as well. So I do think that there's elevated caution that's warranted this time around. However, we have to remember the consumer, as the chart there shows, we've seen these declines in previous months, particularly last December, only to see the consumer rebound really strong. Finally, GDP in the fourth quarter to the first quarter of this year really slowed down significantly, down to 1.6%. Now, if the consumer doesn't pick up steam this month or next, and inflation keeps rising, then we could be in a situation where we get a negative GDP print for the second quarter, and that's what I'm concerned about.
Angelo, are you concerned about that at all? I mean, something else in addition to some of the consumer stuff that Jose was just talking about, I was looking at those household debt figures that we got earlier this week from the New York Fed, showing a record high in household debt, credit card debt ticking up, right? So is that another sign that the consumer might be on a little bit of delicate footing here?
I think if we learned something of the last couple of years is not to underestimate the U.S. consumer. No doubt, indicators point to a softening in consumption. And yes, we might have different paths for low to medium income consumers versus the high income consumers. But at the same time, we spent more than a decade with households deleveraging after the financial crisis. So the starting point is not one of weakness, but the incremental rate of change is likely softer. As this is happening, however, we are seeing other parts of the economy that were under pressure last year, for example, manufacturing and housing, are starting to stabilize and potentially recover. So we see the economic expansion continuing, not at the same pace as we have seen it, but that is likely welcomed by the Fed. We are in this interesting part of the interest rate cycle where good economic data or okay data might be better than great, because the market is interpreting that through the lens of what it means for the Fed.
Jose, another topic I want to get your 2 cents on. President Biden spoke with Yahoo Finance yesterday about these new tariffs on Chinese imports. Jose, just as an economist, I'm curious how you're thinking about that, what you think the potential impact is on the macro in terms of growth and inflation, Jose.
Absolutely, Josh. It was a great interview with Brian. I enjoyed it myself. But the problem is that that's one of the important factors that's driving inflation structurally higher, is the shift from globalization to regionalization. Today, the top importer for the United States happens to be Mexico, no longer China. Whether President Biden becomes reelected or his predecessor wins the election in November, I think that the rhetoric and the actions towards the Chinese will remain quite tense. And that's going to keep inflation higher a few basis points overall, and make the path down to 2% for the Fed particularly troublesome from the good side. And like my fellow panelists just mentioned, we are seeing this manufacturing recovery. We're seeing copper prices start to rally quite strongly, up to around close to $5. And that's really going to threaten the goods disinflation and the commodity disinflation that we really benefited from last year. However, geopolitical tensions are simmering, and that's quite positive for the disinflationary story.
So, Angelo, you might have heard me mention at the top of the show that we now have a street high target for the S&P 500, 5,600 from BMO Capital Markets. Given everything that we're talking about, is that realistic here that we continue? I mean, even if we see some bumpiness in between now and the end of the year, is it realistic to imagine we could get there?
Yeah, I think this rally is not built on sand. There's a good reason that the uptrend in equities continues. We have rising corporate profits. We have an economic expansion that continues and is not threatened at this point. And then we do have the potential for a major pivot in the Fed, with more likely downside in yields than upside from here. And all that supports an ongoing bull market. But I do think that the opportunities might lie beneath the surface, meaning that over the last 12 months, gains have been concentrated in these mega cap technology companies. But we might see more broadening of market leadership. And over the last 3 months, we have started to see hints of that.
Guys, thank you so much. Really interesting stuff and perspective on the numbers today and where we go from here. Jose and Angelo, thank you.
Even with some progress shown today on consumer prices, our next guest says we may not get down to 2% inflation even in the next few years. So what impact could that have moving forward? Joining us now, we've got Christian Lawrence, Rabobank Senior Cross-Asset Macro Strategist. Christian, thanks for coming in person. We appreciate it. So market's very happy about this CPI print. Is it a little bit too much happiness we're seeing?
I think so. And the reaction's somewhat complicated by the retail sales print because that came in much weaker than expected. So I think that was actually the main driver of the move lower in yields. And that move lower in yields certainly welcomed by the equity market and explains that all-time high in the S&P 500.
Do you think this move that we're seeing today then is just a blip? How do you expect to see this play out here over the trading session? And then, of course, as investors have a little bit more time to digest the reports that we got out this morning.
Well, the sensitivity to data releases is going to continue, and we will see these very large reactions. You know, we see it plan out in the rates world where moves of 10 basis points in a day, we saw that yesterday as well. These will become and will remain very common features. And I think we're seeing a little bit more sensitivity also to the activity data than previously. We know the inflation numbers, yes, they're down from the absolute peak, but I still think we're going to see some sticky pressures. Look at that shelter inflation there. That's a real key point. And of course, shelter is one of the main expenses for households.
Well, I just want to go back to what you said about retail being the catalyst for this upside movement that we're seeing today, because as you mentioned, consumers are spending a lot on things that are not measured by the retail sales print. So why should we be putting so much weight on that data point?
Well, I think in order to see real slowdown in inflation, particularly it's the services measure that we really need to focus on. And that's still printing at that 0.4% rate that it has done for quite some time. And without that easing, without seeing consumption start to slow, we're not going to get that 2% target. And I think there's other reasons why that 2% is going to be hard to achieve, more structural global factors, particularly related to more in the way of domestic production and more in the way of trade barriers going forward, as we've seen already.
Christian, there seems to be lots of questions just about how much stock we should put in this CPI print, just in terms of what this is really telling us about the deflationary story, if anything at all. How are you viewing, or what are your expectations in terms of inflation and maybe any sort of improvement that we could see in the coming months?
Yeah, well, it's so important to dig below the surface, right? And when it comes to shelter inflation, I don't see much relief in the coming months whatsoever. And that's going to keep that core services measure high. And actually, when it comes to goods, we had core goods deflation. I actually think in the next couple of months, some of the shipping costs we saw earlier this year, that's going to start filtering through, and we could actually get a little bit more upward pressure on that goods side of things as well.
What's it going to take to see more improvement, stabilization within the rental part, within the services part of this?
Well, I think that's going to be very difficult indeed. The structure of the housing market essentially means there's this deadlock because nobody wants to sell at the moment. And, most people that have a mortgage are fixed at very low rates. And we have one of the highest proportions of people not even having a mortgage at the moment and owning their house outright. So I think this is a real structural factor that means, to be blunt, rental inflation is not going back to the levels it was pre-COVID.
So are high rates inflationary?
Well, that's a very controversial topic. I think at this moment, with the way the economy is right now, there's a strong argument to be made for that.
So what does that tell us about what you think the Fed, what would make the most sense in terms of the Fed's path forward, the timeline of rate cuts, and exactly what we should expect to play out then, given the fact that it almost seems like by the week the narrative is changing surrounding the Fed. Not too long ago we were talking about, hey, maybe we could potentially see another hike. Now the sentiment and now the conversation has really turned to the likelihood of cuts, which I think makes the most sense. But what are you expecting to see in that playbook?
Well, I mean, when you look at the Fed's dot plot and you see at the end of next year one member has rates double another member, it shows you that level of uncertainty out there. So way back in September 2022, our view was 3 rate cuts starting in the middle of 2024, and we've only just changed that to 2 rate cuts. I think the risk to that is actually they don't go twice. But what I will say is that for next year, we only have 2 more 25 basis point rate cuts penciled in, and we have nothing for 2026 based on the idea that we are going to see a lot more in the way of tariffs, and actually inflation is going to be perhaps heading a little bit higher.
How much of the tariffs piece plays into your thesis there?
Yeah, that's a huge part. But as we've just seen, that is now a bipartisan issue. So we will see more tariffs. We will see essentially, it's not deglobalization, but it's a change in globalization. It's a re-globalization, and that's structurally inflationary.
Does that pose a risk here to the economy?
Yes, certainly. It also poses a long-term positive. We could see a lot more in the way of manufacturing investment. We already have. I think that that's going to continue. And it could set up for a healthy economy further down the line. But we know in the short term, tariffs can be quite painful, and they're almost certainly inflationary.
All right, Christian Lawrence, great to have you, and thanks so much for coming in on set and joining us here. Rabobank, senior cross-asset macro strategist.
Thanks for having me.
Key inflation data coming in line with expectations. Traders are getting some reassurance that the Fed could potentially cut rates later this year. About 50% of traders are pricing in a rate cut in September. That's up about 1% prior to the report's release. So we didn't see too much of a change here, at least yet. We want to bring in Matt Stucky. He is Northwestern Mutual Wealth Management's Chief Portfolio Manager. Matt, it's great to have you here. So when you take a look, let's just first start with the market's reaction to this print. You've got CPI coming in line with expectations, retail sales coming in weaker than expected. We are seeing some gains here ahead of the open. How are you looking at this move higher?
Oh, good morning. Thanks for having me. In terms of the market reaction, I think this is a pretty clear indication that the market's reacting to this as a across the board soft print as you look at both the CPI print as well as the retail sales. And really the clearest way you can look at that is the September rate cut odds. Going into today, you kind of had the market pricing in one cut, maybe a small percentage chance of a second rate cut, but now we're kind of pricing in two cuts now. And that has implications for markets. It tends to lift equity prices, as you've discussed already, but it also has style implications. And small caps, as was just mentioned, is one of those beneficiaries of real rates moving lower. And so we expect that to play out today in the market.
Matt, what's also interesting here is, I mean, at least on a basis point level, it looks like there's a significant jump in the percentage or the probability of a rate cut coming in July as well. I thought July was totally off the table here, but coming into this, according to the CME FedWatch tool, just yesterday, we were sitting at about a 26% chance of a rate cut. That's jumped to about 32.5. Now, sure, that's not the outsized opinion, but it still means that this could be lingering out there in the market. To what extent are you looking at a July versus September being that first cut?
Well, I think we got to really watch the labor market as well as retail sales to give us an indication whether or not that probability that jumped about a tenth or so is going to continue to move higher. And what I mean by that is retail sales tend to lead CPI by a couple of months. So if this weakness that we saw in retail sales of the consumer pulling back a little bit were to continue into the month of May and June when we get those reports, July may very well be on the table if that trend were to continue. But our view is not to overreact too much to the data on a monthly basis. If you look at the 3-month annualized trends, there is a story to say that the consumer is pulling back though. So if this continues, July may be on the table, but right now we don't want to overreact to just 1 week retail sales report. When we look at the prior 2 months ahead of this report today, they were fairly strong. And so there is some volatility in the data that we have to respect here.
Matt, I'm curious how you're looking at the recent rally that we've seen in a lot of these meme stocks. We're seeing that rally cool a little bit this morning, but does this signal anything about the broader economy? Does it tell us anything about the health of the consumer, the resilience of the consumer? I'm curious how you're looking at that and then factoring that in to where things stand today.
Well, I think it's one of those things that makes for probably good TV segments, but I'm not so sure that it really impacts the consumer so much. Look, I'm probably the wrong individual to ask about meme stocks. I tend to be more fundamental with our investment decisions as we relate to kind of how we're managing our equity portfolios. But it is interesting that the consumer is still out there and willing to take risk. And the definition of the meme stock craze is risk taking. So, the consumer must still be in a fairly decent position to kind of risk to this level. With the whole kind of idea is that you're buying a stock with the anticipation of it just moving higher in the form of a momentum trade and a short squeeze. So that's not quite the investment strategy that we would recommend, but clearly it's a popular one today.
So then, should macro investors then just be ignoring what's going on right now in the meme stocks?
I don't think it's really impacting macro forecasts now.
All right. Matt Stucky, great to have you. Northwestern Mutual Wealth Management Chief Portfolio Manager. Thanks so much. Let's talk about this move higher that we are seeing here because futures are moving to the upside. CPI print coming in line with expectations. The data coming after another report pointed to stickier inflation. That was PPI out yesterday. For April, it rose at 0.5%, which was more than we had expected. So let's talk about what this means for the path forward. For that, we want to bring in Stephen Juneau, Bank of America Securities, a U.S. economist. Stephen, it's good to see you here. So when you take a look at this print that we got in CPI, that was essentially very close to consensus. We had a weaker than expected retail sales print. I'm curious what your first takes are at these two prints and what it ultimately tells us about the state of the economy right now.
Well, I think your previous panel summarized it perfectly. You know, it's a step in the right direction. We've seen a step down in inflation from the first quarter. That was a very kind of ugly first quarter. We saw a torrid pace of inflation growth. But now we get kind of this step down. But is it really enough for the Fed to get too excited about? Probably not yet, but it is kind of confirmation that 1Q was maybe a little bit anomalous, a little bit statistical noise. We do think January was boosted for some statistical reasons, and now maybe you're seeing a bit of a slowdown. Then you layer on top, is the Fed in restrictive territory? Well, retail sales at least tells you that maybe they are starting to see that more and more. Now, this is just really capturing the good side of the economy. It also probably reflects a lot of payback from a very strong print last month because you did see non-store retailers pull back after a very strong March. So maybe a little bit of payback there. You kind of want to look and smooth through the monthly profile there and see that on average, you know, the consumer is still in good shape. We're still spending, but are we starting to see durable goods spending maybe pull back a little bit because of higher rates? I think maybe you're starting to see a little bit more evidence and the Fed can be a little bit more confident they're in restrictive territory when looking at retail sales, and they can be a little bit more confident that inflation isn't running away from them when they look at the CPI data.
Yeah, Stephen, one of the things that came up in our panel just a few minutes ago was when we could see a plateau in inflation. And one of the comments that we received was over the summer we could see that. From your estimation, does this data kind of point us in that direction, and what would you be looking for?
So we are, I mean, broadly speaking, when we look at the Fed's preferred measure of inflation, so PC inflation, we're forecasting progress on a sequential basis. So that 1Q data is going to look a little bit outside the broader scheme. We're going to get better data moving forward. But when you look at the year-over-year rate because of unfavorable base effects, well, we think PC inflation is really going to stagnate this year, kind of across the board. So we have PC inflation ending the year, the core PC inflation, ending the year at 2.9%, which is roughly unchanged from the end of last year. So we do think we're in this year where the last mile is just that much harder than what we saw last year. It's more and more about services inflation, and that's going to take some time to bring down. Some of that is due to housing just being sticky, being inertial, but we have seen progress there. It's just a matter about when, not if, that comes down because market rents have certainly normalized.
Yeah, Stephen, talk to me a little bit more about that and just what you expect that timeline to look like in that part of the CPI print for more stabilization.
So for that, I mean, I would say we're looking for firmness over the next few months. Typically, the best forecast of this is for the next month is the previous month. That's kind of what you find out just statistically. It's not a very insightful argument. But then when you look at the broader trajectory, I think the second half of the year is probably where you start to see a little bit better improvement. So instead of 0.4s on shelter, on OER, on rent, maybe you're in the 0.3 region. So you're getting kind of that step in the right direction. And that's going to be a source of relief for the Fed because they are continuing to look for that to happen.
And just lastly, while we have you here, in an exclusive interview with Yahoo Finance, President Biden told our own Brian Sazi about wage growth and how that is affecting inflation here. Just want to play this clip and get your reaction.
I think inflation has gone slightly up, but the fact is that I think people are just uncertain. And that's why we got to be steady, stay the course.
Just want to get your reaction there, Stephen, and what this all means in terms of the trickle through to inflation.
Yeah, so we have seen kind of real wage growth, real income growth. That purchasing power has started to really recover after being shocked downwards during kind of the past really more than the past 2 years, but during the pandemic years where we saw kind of that initial burst of inflation. And now you're starting to see purchasing power really normalize. So I think that's good for the consumer. It's what you would want to see. You want to see a period where wages are actually kind of outpacing inflation because that's going to get you back to kind of a little bit better purchasing power picture. You're going to be able to cope with these higher prices, all else equal, because you're unlikely to see prices outright decline, right? We're unlikely to see outright deflation. We're not going back to 2019 prices. So the way that the consumer, that the U.S. economy kind of copes with that is we need to see a period of wage inflation a little bit stronger than price inflation. And we are seeing that. I think that is an encouraging thing to be optimistic about the U.S. economy, which we are. We expect growth to continue at a pretty strong pace over the next 2 years.
All right, Stephen Juneau, Bank of America Securities, U.S. economist. Thanks so much for taking the time to hop on with us this morning.
Thanks for having me on.
Futures climbing higher after April's inflation print comes in line with expectations, and we're taking a deeper dive into three sectors that have been hit by sticky inflation: food, shelter, and transportation. And we've got team coverage to break it all down with Yahoo Finance's Brooke DePalma, Madison Mills, and Jennifer Schonberger standing by. Brooke, let's start with you here in studio. You're watching food as consumers are continuing to monitor grocery prices here.
Yeah, that's right. Americans are still feeling the impact of those higher food prices in April. They still felt it in April, rather. Overall food prices jumped 2.2% last month, but was unchanged compared to the month before. Now, the cost of groceries alone increased 1.1% compared to a year ago, but did see a slight decrease compared to the month prior, down 0.2%. Now, some of the ingredients that saw the highest jump in inflation last month include flour and prepared mixes, up 3.2%. Lettuce up 2.3%, and butter up 4.3%. Now, this report comes as a group of 40 lawmakers led by Senator Elizabeth Warren did call on President Joe Biden to investigate grocery store chains for price manipulation. Now, in the letter, she urged the president to take action to lower food costs. And what drove overall food prices last month was really actually not just grocery prices, but what we saw of food away from home. Labor inflation and higher commodity costs did continue to persist. The cost to dine out at restaurants jumped last month, up 4.1% year over year and up 0.3% month over month. And we've heard from companies like McDonald's and Starbucks, they're starting to feel consumers push back because of these higher prices. Both those companies posted sales growth that missed Wall Street's expectations. Another sector, I know, Maddie, you're watching, shelter, that contributes to just over a third of the CPI print. I know Main Street and Wall Street are watching out for that. Maddie, what did you see in the report?
That's exactly right, Brooke. It's really interesting because we're seeing that 70% of this print can come down to the contributions that we saw from just shelter and gas. So taking a look at some of the headline numbers that we got from that particular part of this index, shelter up 0.4%. We've seen that over the past 3 months now, so just in line with what we've been seeing. But that brings the year-over-year contribution of shelter up to 5.5%. Previously, we were at 5.7%, so we are seeing a little bit of progress there. The shelter picture of inflation becoming increasingly important as a gauge of whether or not the Federal Reserve's rate hike cycle is having an impact on the current state of inflation, particularly when you consider that shelter alone contributes to 50% of the overall CPI picture, and it's about a 36% weighting in the CPI. So when you are looking at what the Federal Reserve looks at, they're able to take out some of that data, including owner's equivalent rent, for example. So that picture, the super core number that we look at, a little bit better when it comes to looking at the progress the Federal Reserve has had. But Jen, I know that you're watching transportation and services costs. What are you seeing there?
Hey, Manny. Yeah, that's right. Transportation costs still adding quite a bit in this last report, up 0.9% month over month. So a little bit better than the month before, which was up 1.5%. If we look at that year over year, it was up 11%. But I really want to call attention to services because that is something that the Fed looks at closely when they look at the different components of inflation. And that clocked in at 5.3% for the month of April, holding the same level as March. So on its face, you could think, oh, well, services is still looking sticky. That's not great for the Fed. But if we take a step back and sort of look at the glass half full, you'll see that, okay, fine, it's at 5.3%, but it's holding at 5.3%. If you look back at the beginning of the year, it started at 4.9% in January, going up to 5.3%. We saw sticky inflation for the first quarter, so perhaps maybe it's leveling off before it begins to turn down again. Of course, we will need to see more months of this to see if that is indeed the case. If you look at services excluding shelter, that looks a little bit better at 4.9%. Overall, this report looking good for the Fed. Is it enough to change the calculus at this point? No, I don't think so. Jonna?
All right, Jen, Brooke, and Madison, thanks so much to all three of you for breaking down what we have seen in different parts of this report.
Consumer prices rose 0.3% in April, in line with expectations. Futures jumping on the print. And for more on the latest inflation data, we're joined by Gregory Daco, who is the EY Chief Economist, and Peter Tchir, who is the Academy Securities Head of Macro Strategy. Great to have you both here with us. Just want to get broad strokes reaction. Greg, I'll start with you.
Well, I think generally speaking, inflation is moving in the right direction. We had this softer than expected headline CPI print. Core was in line with expectations. If you look at the underlying inflationary dynamics, they still point towards disinflation. It's a little bit slower than we had anticipated at the start of the year, but that momentum is still in place. You're still seeing the fundamentals of slower consumer spending growth that is adding to disinflationary pressures. And I think this recent retail sales report, while not alarming, does show that consumers are exercising a little bit more scrutiny. That's generally disinflationary. I think that disinflation momentum will continue. We'll probably hit an inflation plateau over the summer and into the fall, but nonetheless, the underlying disinflationary forces are still very much in play.
Peter, what do you think? We have the futures reaction right now. We are certainly starting to see a surge here on the heels of this print that we got on CPI, also that retail sales number. But what do you think this tells us just about how worried investors are about this possible reacceleration of inflation and the fact that this report actually starting to ease maybe some of those concerns?
Yeah, I actually think we're going to come into a very confusing stage where people have been hoping for signs of disinflation. We're getting it, right? We're seeing the economy slow down a little bit. And so far, we've been cheering that on the bond side, which makes sense. So far, equities, though, have also been rallying as bond yields go lower. I think that's about to change as people start digging into the economic realities where a lot of the economic data is getting weaker. I like to look at the City Economic Surprise Index. It's down a lot. And data after data point is weaker, like retail sales. So I think part of the bond yield rally today is more attributable to that than the CPI. And equities following that may turn out to be a mistake where equities realize, whoa, we may have gone and jumped from no landing back to bumpy landing.
So then what does that tell us then, Peter, about what that action could look like then over the next several trading days?
So I think bond yields stay roughly where they are. Maybe they go a little bit lower. Maybe they start creeping higher. We've had this 430 to 450 range for the last week or two, and that's been working pretty well on 10 years. So I think that settles in. I think equities kind of go through this, rally that we're getting. Then people start looking around, who buys it for me? Who buys next? Then they start worrying about NVIDIA earnings. And I think you see stocks roll over a little bit. It's not going to be a hard rollover coming into NVIDIA, but I think you see that start slowing down as people question the state of the economy. And the only last, kind of wrench to throw into this whole equation is you are starting to see some commodity inflation, right? Everyone's talking about copper, things like that. Do you start running into this risk of stagflation? It's not my base case, and I would have completely dismissed it about a month ago. I don't think we can dismiss it anymore, especially after we added some new tariffs yesterday.
Greg, I'm not going to ask for your comments on NVIDIA, though, if you want to talk about generative AI, which I know we have before, you're more than welcome. I'll put this question to you, though. One of the huge things that we question coming into this report is if this was going to be a report that ultimately changed the mind of the Fed one way or the other going into either September, which is still the earliest case for which we could see a cut, or December. Does this change their calculus tremendously?
Well, I think it does influence how markets are looking at the Fed's reaction function. And that, unfortunately, has been quite exuberant over the course of the past few months. We've seen every single data release be over-analyzed in terms of the underlying trend of inflation, of the labor market. I think Peter is spot on when he describes the downside risks to the economy. The economy is slowing, the labor market is slowing, job growth is moderating. That will put downward pressure on income for households and lead them to exercise more scrutiny with their purchases, which generally tends to be disinflationary. Energy prices aside, we have continued to see disinflationary forces in terms of slower final demand, in terms of reduced markups. We saw that in yesterday's PPI data, in terms of moderating wage growth, and still moderating rent inflation pass-through into CPI. Combine all those elements, that would lead you to believe that the Fed will start easing monetary policy in the coming months. When it does so is not that clear yet because the Fed and Fed policymakers are a little bit more concerned about the risk of inflation reaccelerating, as Peter highlighted. But we continue to believe that disinflationary forces are in play, and with some softening of the labor market, I still think a July rate cut is a possibility in this type of environment.
Peter, what do you think? What in terms of the Fed timing and what that you think that most likely looks like?
Yeah, I've been kind of stuck that we'll get two this year, June, July. I think it's probably more likely July and maybe December. But I do think Powell, as he said yesterday, he is looking for an excuse to cut. He is going to want to cut. And he really doesn't want to cut in September, right? That'll be kind of peak election talk. So I think he wants to get at least one done this summer. So I'd agree that I think, July rate cut should be on the table and probably one more this year. He gets two. The data probably supports that. We would need something strange. But that's why I also think equities are going to start looking and saying, hey, we're starting to cut because of the real demand following and weakness in the economy, not just because of disinflation. And that's where I think equities are going to struggle a little bit more than the bond market.
Peter, I want to bring up a point that you mentioned a couple of minutes ago, and that was this risk here of stagflation. Talk to us a little bit more about the risk that really poses here to the market, and then the tariff tie-in, just why that raises that risk that maybe we could see stagflation.
And I would say a lot of this comes from Academy Securities. I work with 22 retired generals and admirals. So we spend a lot of time thinking about the geopolitical risks. And across the world, commodity risk is high. Venezuela's making some noise again, right? We're depending on them. You still have nothing resolved in the Middle East. Does Putin do something to disrupt oil or commodity flows coming into the election? Because presumably Putin would like Trump to win and high inflation be bad. And in the past month, we've seen the U.S. kind of being forced to exit parts or countries within Africa, North Africa, right? So I see commodity risk there globally. I do think China is going to respond to the tariffs. That's going to put some inflation pressure back into the system. So it's not going to show up in the next 2 or 3 months, but I think in the next 3 to 6 months, there is going to be some commodity risk, some sort of shock potential there. And I do think China will respond to the tariffs negatively, and that will reinsert inflation pressure just as the economy is slowing. So that's where I feel like stagflation is a low probability event, but I would knock it from a 0 to maybe a 5 to 10% chance in the next 6 months.
Gregory Daco, who is the EY Chief Economist, and Peter Tchir, Academy Securities Head of Macro Strategy. Thanks both for joining us here to break down these numbers this morning. Appreciate it.